Good morning, ladies and gentlemen. Well, last week I told you that we went into risk off on the risk dial, but that I was highly dubious because the scores were still positive, and indeed we had the rally. And I also told you that every time that the scores went to, rather than the moving averages went to risk off without the scores going negative, we had some sort of a false signal like here and here. But what I don't doubt is that we will revisit the lows at some stage and then we see kind of thing. With that in mind, we have the QRA, so let's have a look at what the QRA is likely to bring to us and why I think that at some stage we retest those lows, probably make new lows but not go very far. So let's have a look at what happened to term premium since the last QRA. The last QRA was here, and you see that the first reaction was to take term premium down. That was a relief that that QRA was not worse than the market could have feared, and therefore we had a bit of a relief rally of 10, 11, 12 basis points on the term premium. And then throughout the term from there, we have increased term premium. I suggest that the same thing is likely to happen here, that we're likely to have a term premium contraction as the first reaction, and then we continue with higher term premium. Why? Because this made no sense, because issuance is going to be very heavy. It's just that it was going to be less heavy than we feared. So much the same kind of reaction is going to take place, I think. And this is why. This is the text from the previous QRA, and it says quite clearly that they don't expect any further increases in nominal coupons or FRN auction sizes for at least the next several quarters. I mean, it couldn't be clearer, could it? We've had a lot of conspiracy theories out there, one of it which is that they're going to pay down the TGA, that they're going to reduce the TGA by a lot. So the TGA is there for a reason. And the reason is because we had the problems that we had on September the 11th, and the market was closed for 5 days. And they couldn't refinance, they couldn't issue bills, they couldn't do anything. So the reason why the TGA is at 750 billion is because it's not law, but it's policy to keep 5 days worth of expenditure in the TGA. If they were to reduce the TGA, it would be such a political move that it's not true. They just wouldn't do it. They just wouldn't even think about it. So that conspiracy theory to me is a load of rubbish. They're not going to pay down the TGA. They are going to maintain it at 750 billion, and then we look at what the gross and net issuance for the quarter is going to be. And when we put it all together, we come up with something like this. On Monday at 3 p.m., we get the financing estimate. And the headline, I think, is going to be somewhere around 525 to 500 billion. And that will be slightly positive. Don't forget, we don't know what the combination between bills and bonds is going to be, but it's likely that they keep it at the current, 25-75%. So I think the first reaction is a positive reaction in both bonds because of term premium reduction and equities. And then on Wednesday at 8:30, we get how much is actually offered gross. I think it's going to be about, 1 trillion, which would mean that the net issuance of coupons is going to be around the 500 billion area. And the first reaction to me is going to be buy assets. But I'm prepared for any combination of the above. I'm just telling you what makes sense to me, given what they stated in the past QRA and how the market reacted to the past QRA. And I think that this QRA is going to be very similar to the last, because it makes sense. If they say they're going to do exactly the same thing as they did before for several quarters to come, well, this is the next quarter. And therefore, I expect the net issuance to be exactly the same as it was last time. And the reaction last time was positive, i.e. one of relief, the first reaction. And then only after a week or so, we had the term premium increase again, because another 500 billion net of issuance is, it's not it's not easy to digest, and therefore I expect the reaction to be exactly the same as the reaction we had last quarter. Given the reaction last time, I expect much the same kind of reaction this time, and therefore I expect a flattening. This is 2's 5. I expect them to flatten to around 36. And then if we have a look at 2's 10s, I expect them to flatten to around, 40. And if we look at 5's 30s, I don't expect very much there, because it's not going to go anywhere. I mean, it's just going to stay in this kind of range. So I'm expecting the reaction to be, the positive reaction to be less in the 5s, more in the 10s and 30s. And if we look at the 10s, I expect them to trade down towards these levels around the 450, and the 30s to trade down towards these levels around 465. And from there, I expect the next leg higher to be. Don't forget, if we have a look now and change this to a weekly chart, we can go and have a look at what the reaction was to the last QRA, and basically it's here. That is that candle that week. And you can see that, from high to low, we went from, 436 all the way down to 405. So we went down almost 25 basis points and, retraced half of it. And then we just basically started trading higher with why? Because we have term premium expansion. And I think exactly the same thing is going to happen again. We've had 4 weeks of higher yields. We have, a move back down to 450, 455, something like that in 30s. 1 week around here, and then we continue up towards the 5% area. So what I'm saying is that at some stage over the next week or so will be our opportunity to put on A, the steepener, and B, get really short of bonds. Because, the QRA matters insofar as it sets the supply. The supply we know is going to be big. The fact that it's going to be slightly smaller and without all the, what shall I call them, the conspiracy theory kinks that many idiots out there have, the first reaction to me is logical that it's one of relief. But that is the opportunity to get short of bonds. I expect much the same kind of thing from Germany. I think this is the Bund. We go back down to something like, 247. Everybody gets excited. Yes, we've done it. We're going to go lower in yield now. Oops. And it goes straight back up. So I expect the same kind of reaction there. Even the Schatz, as you can see, it's, something like 292, 290. and then we go back up. I'm giving up on the idea that these yields are going to go down much anytime soon. I think any kind of a flattening of the curve is an opportunity to put on the steepener, and there is really not a lot of hope that these bond yields will start coming down and stay down for the long term. It would make sense to me that the first reaction on the QRA, if it's expected, if it's as I outlined it, but I've given you all the scenarios, and of course I'll tweet to you as soon as it comes out which scenario it is, so we can either buy all assets or we can sell them all, is that the first reaction in the Dixie is one of down. Where can it come down? I would have thought that it's going to come down to somewhere around here, 104.80-ish, 104.70-ish, and that will be the opportunity to actually buy some calls on the Dixie, because I think within a couple of weeks it's straight back up to these highs around 107. That would make sense to me for the same reasons as I explained to you in the for the bonds. You get a relief rally of 20 basis points. Everybody says, wow, we've dodged a bullet there, haven't we, guys? And then the realization that the supply of duration is not ending anytime soon, and that they have to issue, and that, you know, every week you're going to get more bonds, and therefore rates head back up, and the Dixie heads back up with them. If we want to look at Euro Japanese yen, you'll see that the differential between tens moved very, very slightly over the course of the week, and it's still in a very predetermined range here between 153 and 181. And that range is actually much lower than the previous range where we were in all the time. Now compare and contrast this picture to the FX one. And here it is. And this is what happens when everybody wants to get into a trade, but they don't have a technical signal, and they all pile in, and then they all get stopped out. We are now through the weekly Bollinger Bands, we are through the daily Bollinger Bands, we are through everything, and we are a long way away from the 200-day moving average. I would have thought that this is the time that you want to put on some kind of an option play in either the Japanese yen becoming stronger, which would make sense because if the Dixie goes down as a reaction to the QRA, the relief, I would have thought that dollar yen from 158, 159, whatever it is going to come back down to at least this kind of area, 152, 153. That would seem to be the logical reaction to me. And then even if Euro Japanese yen does not really move all that much, you'll at least make some money on the Japanese yen option. So first thing, I'm going to buy some yen calls because I think it's time, and this kind of thing, you know, it's not going to last for huge amounts of time, this kind of overboughtness. I think everybody is now stopped out, and if you do a call spread, a call spread on the futures, a put spread on the Japanese yen, you know, somewhere with a lower target being 153, 154, I think that at some stage over the course of the next couple of weeks, if the QRA is exactly as I expected, you should make money, because as I showed you, I think the first reaction in the Dixie has to be down, and that should drag the Japanese yen higher on the futures and lower on the FX. I don't think gold is going to react much to the TGA. Of course, it'll be buoyed by the fact that, you know, if I'm right, that bonds are rallying for a few days. but I think that this will actually turn out to be an ABC, and that any kind of a move up to 2400 is an opportunity to buy something like a 2400, 2300 put spread, and I think it'll return down to around this kind of area, and then we'll have definitions, and we can decide what it does afterwards. This has been a crazy move, and I think that gold is probably going to react back down towards these kind of levels, 2260, something like that, over time, and do an ABC. The first move should be up towards 2400 on a relief rally in rates, and therefore gold should go with them, but there it should stop, and then we have the ABC down. I'm not really expecting all that much from DBC. I think it's flagging on the weeklies, and I think it'll continue to flag on the weeklies. Very little chance that we start breaking higher immediately, simply because I don't see that oil can break higher immediately. I think it's just going to trade sideways for a bit, maybe do an ABC, and then react in a few weeks' time back up and test the highs around the 90 area. I think it's going to be a quiet few couple of weeks for oil. I don't think that that one is going to be the major mover, and therefore DBC is going to be relatively quiet. And that would make sense if DBC basically just goes sideways while gold reacts on an ABC, and then we correct all that overboughtness that we have, let's call it, on the spread. That should basically do it. Let me get you out the spread. So we get a move back down to here on the spread, and then we get another move higher. So that would make sense to me. A quiet week in commodities where they continue to flag while bonds do better, and eventually equities should do better as well. So let's have a look at my clean chart on equities, and I think that for big events like the QRA is probably the wisest thing to do. Having enlarged it, let's have a look at what the real, important levels are. And I think the really important level here is 5180. The expectation has to be that we go and test 5180. It's a relief rally. Wow, the QRA wasn't that bad. Bonds are rallying 15, 20 basis points. Yes, life is good. Everything is perfect. The first reaction should be to buy equities to around the 5180 area. And I would have thought you fill this gap. We still have this gap to this level, to the closing level, which is 5197. Let's call it 5200. There I expect equities to have the first hesitation, and then we see what they're made of. Don't forget, next week we have also Apple earnings, we have Amazon earnings. So by the end of next week, we'll have the majority of the important shares having reported, and by weight, well over half of the S&P having reported. So therefore, I expect the first hesitation to happen at this kind of level around the 5200 on the SPX. So now let's have a look at the weekly chart. It's likely that we get this hesitation at these higher levels around the 5200, but people will start getting bullish there. And just as I told you that the bonds are likely to continue higher, having taken in the term premium on the relief rally, they're likely to keep on going higher. So I would expect that this 5200 is going to be a very good level to buy a 2, 3, 4 week put spreads, because I do think that we retest those lows when the bonds make the new yield highs. And this could easily turn out to be a corrective pattern, and that we go down to just short of 4800, let's call it 4900. stop everyone out below these lows, and that should be enough, kind of thing, after 2-3 weeks worth of price action. I find it very difficult to believe that equities are going to keep on going without the bonds enabling them to go. I don't think there is enough probability of an earnings expansion. And even if earnings do continue to be pretty damn decent, the fact that new yield highs are being made on the 10-year and the 30-year should compress the multiple and more than negate those earnings expansions. So I do expect to see a new low in equities over the course of say a month, but I don't think it's going to be by a lot, and I don't think it's going to be sustained. I think equities are now going to be in a pattern for 2 or 3 months over the course of the summer, and I don't think that we can break out to the upside because of all the worries that we have about the election, about bonds, etc., etc. I think we're going to go into a quieter sideways period for a bit. I still like Europe. I think it's trading better than the US. I think it's more volatile than the US, but it's certainly trading better and with more reason to perform better than the US. The multiples are so much lower, and I think that, you know, maybe another month of consolidation here above 48.50, and then at some stage they try to break higher. Certainly I think that the spread against the US is going to keep on coming in, and that Europe should be preferred to the US for the next several quarters. I think it makes much more sense that European equities catch up. They've got much lower multiples, they've got much higher chance of lower interest rates, and to me it makes sense that they lead the next move higher after they've consolidated for a bit and allowed the SPX to go and test the previous lows, and then we see. But I certainly prefer Europe. I prefer EEM, which just basically showed you that it did not want to go down. I think EEM at some stage will certainly this year trade 42.25, and I even expect it to go and trade at the 200 period moving average, which is around this 44 area. I certainly expect EEM, Europe, and even Japan to trade better at some stage. I think Japan next week definitely trades this 39,100 area, and then we see. All it's doing is basically correcting, allowing the moving averages to catch up, and then it'll have fuel for a further move higher. I realize that I haven't even mentioned the FOMC, and with good reason. There's nothing to say. What can Powell possibly do apart from continue with the tidal mantra that he is data dependent and that he still doesn't have enough confidence to cut rates? Well, you know, after the numbers that we had last week on inflation, the PCE, it's unlikely that he's gained any more confidence. And the most bearish thing he can say is that he is taking June off the table completely. Well, the pricing has taken June off the table completely in any case, so there's absolutely no upside for him to say that, or for him to be very bearish. Why would he do that? You know, it doesn't make any sense. At the moment, he is like, what is he doing? He's herding cats. You have people on the FOMC, governors on the FOMC, who want to cut rates. You have others who don't. But what is very unlikely is that he can go from a 3 cuts in 2024 and whatever cuts in 2025 to no cuts in 2024, and even hikes in 2024. He's definitely, the committee doesn't move that fast, and therefore all he can do is say that they're doing nothing, they're waiting, they're data dependent, and as soon as they have enough confidence that inflation is headed sustainably to 2%, they will cut. But that is a long way away. So basically the market has priced out June, the market is pricing out September, and the most likely is December now. There's really nothing he can say, and I'm expecting nothing from Powell. Anything he does say, of course, we'll react to, but the expectation has to be that it's one big nothing, the FOMC on Wednesday. I've changed all the levels, and here I've put in the links to the statement by the Treasury about the QRA and why it is that I am expecting nothing much. And here are the links to the tables that I prepared, or rather Andy prepared, where we have the expectations of the issuance size. I really don't think that, I know that some people have wildly different expectations, but I've given you my justifications, my reasoning for why the QRA should be what I think it will be, and what the reaction of assets is going to be. And that is one, first of all, of relief, just like it was relief the last time. Now, what other people's expectations are, I don't know, but I think it's all a load of conspiracy theory. Certainly the one I think is most unlikely is that they're gonna draw down on the TGA. To me, that would be political suicide and stupidity. Thank you very much indeed. Tweet you, of course, on Monday, and we are, of course, now prepared for any eventuality in the QRA.